Hello, good morning, ladies and gentlemen. I'm Timothy Marbun, and I would like to welcome you on behalf of the team to the launch of World Bank Indonesia's latest report, Indonesia Economic Prospects, Financial Deepening for Stronger Growth and Sustainable Recovery. It is my honor to host the launch and discussion today. Our event will continue until 11 a.m. Jakarta time. In this event, we will hear remarks from World Bank Country Director for Indonesia and Timor-Leste, Ibu Satu Kahkonen, and also from Bapak Stephen Scott, Deputy Head of Mission from the Australian Embassy in Indonesia. Now, we will then get a chance to hear the keynote speech delivered by the Governor of Bank Indonesia, Bapak Peri Warjio. When we will continue with a presentation on economic recovery by lead economist of World Bank Indonesia and Timor-Leste, Bapak Habib Rab. And afterwards, we will get to learn more about the financial sector deepening from World Bank Indonesia and Timor-Leste's lead financial sector economist, Bapak Francesco Strobe. Now, we will have a chance to elaborate more on the topic through a panel discussion moderated by Practice Manager, Finance, Competitiveness, and Innovation Global Practice of World Bank East Asia Pacific, Ibu Cecil Tironyang. Now, joining us for the discussion are Head of Center for Macroeconomic Policy, Fiscal Policy Agency from the Ministry of Finance of the Republic of Indonesia, Bapak Abdul Rahman. Also joining us, Special Advisor at the Coordinating Ministry for Economic Affairs and Head of Indonesia Financial Group Progress, Bapak Reza Y. Siregar, and Coordinating Vice Chairman of Maritime Investment and Foreign Affairs of the Indonesian Chamber of Commerce, Ibu Sinta Kamdani. Also joining us later on, SEVP Treasury and Global Services of PT Bank Rakyat Indonesia, Bapak Ahmad Royadi. Now, the options of using Bahasa Indonesia or English are also available on your screen. You may switch the language during any part of our event. Bagi Anda yang ingin mengikuti keseluruhan acara dalam Bahasa Indonesia, Anda bisa memilih fitur penerjemah di bagian bawah layar Anda dan memilih terjemahan Bahasa Indonesia. Now, for the media, there will be a press conference immediately after the event. You will need to be recognized as a registered media to join. Now, please refer to your personal invitations on how you may take part in the press conference and follow the instructions provided in your invitation. The questions during the press conference will be conducted through Slido. We invite you to follow the World Bank Indonesia Twitter account @Bank Dunia, and also please use the hashtag IEP Bank Dunia for the conversation in social media. Ladies and gentlemen, our event today will start with remarks from World Bank Country Director for Indonesia and Timor-Leste, Ibu Satu Kahkonen. Good morning, Ibu Satu. I hope you're well.
Good morning, Timothy. Good to see you again, and I'm very well.
Time is yours, Ibu Satu.
Terima kasih, and selamat pagi dan selamat datang. It's my great pleasure to welcome you all to the virtual launch of the June 2022 edition of the Indonesia Economic Prospects. And let me start by acknowledging our distinguished speakers. Honorable Pak Peri Warjio, Governor of the Bank of Indonesia, Mr. Stephen Scott, Deputy Head of Mission to Indonesia, Embassy of Australia, Ibu Sinta Kamdani, Coordinating Vice Chairman of Maritime Investment and Foreign Affairs at Kadin, Pak Reza Siregar, Special Advisor, Coordinating Ministry of Economic Affairs and Head of Indonesia Financial Group, Pak Ahmad Royadi, Senior Executive Vice President for Treasury and Global Services, PT Bank Rakyat Indonesia, and Pak Abdul Rahman, Head of Center for Macroeconomic Policy at the Fiscal Policy Agency of the Ministry of Finance. I would also like to thank Australia's Department of Foreign Affairs and Trade for their continued support for World Bank's analytical work in Indonesia. Thank you very much. Indonesia is recovering from the COVID-19 pandemic, and doing so at a steady pace. The country has benefited from sound macroeconomic management during the crisis and is now seeing its dividends as the economy is reopening. Consumer confidence have improved, and Indonesia is also reaping benefits from improved terms of trade. But global conditions are shifting, and downside risks are rapidly piling up. Global commodity prices are at record high level, and global inflation is on the rise. The world economy is, as a result, slowing down significantly. And the central banks are at the same time raising interest rates, which is leading to tight financing conditions, also for Indonesia. And last but not least, there are geopolitical risks with the damaging effects from the war in Ukraine. In this context, I would like to highlight 3 key lessons from the report that we are launching today. These lessons can help Indonesia manage the uncertain global environment and build a stronger and more resilient economy. The first lesson is that macroeconomic stimulus in Indonesia has worked to partly mitigate the impacts of the pandemic. The first fiscal package focused on supporting healthcare, vaccination, and social assistance to those that need it most. And that package was followed by subsidies to contain cost-push inflation. Moreover, this expansive fiscal policy complemented accommodative monetary policy, which helped accelerate credit to the private sector and support economic recovery. Indonesia has so far benefited from the stable macroeconomic starting position in 2020. And that starting position was characterized by low debt levels, adequate foreign currency reserves, and manageable vulnerabilities in the financial sector. However, these tools will be less available going forward, as the fiscal cost of subsidies are rising and the budget is becoming increasingly stretched. Inflationary pressures are mounting, and external financing conditions are becoming increasingly tight. And that leads us to our second lesson. The second lesson is that as fiscal and monetary policies become less available, structural reforms are critical to promote growth. These include creating fiscal space through tax reforms to expand spending on pro-growth and pro-poor programs, as well as financing public investments, infrastructure investments, to block the very critical infrastructure gap that still exists. To develop greener downstream industries, replacing trade restrictions that exist today with the mix of fiscal, trade, business environment, land management, and infrastructure policies will be vital. And prioritizing business environment reforms to support micro, small, and medium-sized enterprises' access to credit and their formalization is also important. And digital and green transition to address scarring effects from the pandemic will be critical to boost growth and productivity, as well as competitiveness of Indonesia. The report launched today highlights some of these structural reforms, many of which the authorities have already started tackling, but their implementation would need to be accelerated and deepened at this point. The third and final lesson that I would like to highlight from the report is basically the importance of addressing the financial deepening. In a modern economy, the financial sector is considered to be the backbone of expanding economic activity. If not addressed, it will drag economic growth. Indonesia's financial sector has shown solid macro-financial fundamentals during the pandemic. However, the sector suffers from structural shortcomings which hold back financial development. As of today, Indonesian financial sector is relatively small, costly, and exposed to global risks. Policymakers have, however, an opportunity to address these risks as well as constraints. And I would like to highlight 3 opportunities that policymakers have to address these risks. The first opportunity is to increase the demand and supply of finance. This requires expanding the sources of funding by growing the institutional investor base and ensuring access to digital financial services. This in turn would enable lending and use of financial services. It would also facilitate the development of new green finance instruments to support the low carbon transition. The second opportunity that authorities have is to improve the allocation of resources through the financial sector. The expansion of digital financial services, the promotion of competition in the banking sector, and the establishment of a sound financial infrastructure are all keys that can help to channel savings into the most productive investments in a cheaper, faster, safer, and more transparent way. And the third and final opportunity that the policymakers have is to strengthen the capacity of the financial sector to withstand financial and non-financial shocks. This is crucial for the financial sector to efficiently allocate resources, assess and manage risks, and support the real sector, which is the job of the financial sector. The strength of financial regulations, including on integrated supervision and legal protection of supervisors, as well as crisis preparedness and resolution frameworks, are important to ensure stability of the financial sector in Indonesia. Moreover, climate-related shocks, to which Indonesia is particularly prone to, may also pose risks to the stability of the sector and require adequate risk management. Now, to operationalize these 3 opportunities, reforms will need to focus on increasing the depth, improving the efficiency, and strengthening the resilience of the financial system. My colleagues Habib Raab and Francesco Straub will elaborate on our assessment and recommendation for Indonesia to leverage structural reforms and financial deepening to support economic growth and sustain economic recovery going forward in this beautiful country. I'm very pleased that we have such a distinguished and high-powered set of keynote speakers and panelists with us today. I'm very grateful for your time, Pa Perry, Pa Steve, Ibu Shinta, Pa Reza, Pa Ahmad, and Pa Abdurrahman. We look forward to hearing your recommendations and insights for Indonesia. I hope you all will enjoy this event. Terima kasih banyak.
Any remarks? Esteemed guests, next remark is from Bapak Stephen Scott, the Deputy Head of Mission from the Australian Embassy in Jakarta, Indonesia. Pak Stephen, the time is yours.
Terima kasih Timothy dan selamat pagi. Yang terhormat Gubernur Bank Indonesia Dr. Peri Warjio, yang terhormat Direktur Bank Dunia Ibu Satu Kakanen, dan para pembicara yang saya hormati, and also to Ibu Shinta, Pak Reza, Pak Ahmad, and Pak Abdurrahman. Thank you for your time as well. Dan terima kasih kepada Bank Dunia atas peluncuran laporan Indonesia Economic Prospect yang pertama untuk tahun ini. Dan maaf, izinkan saya untuk melanjutkan dalam bahasa Inggris ya. Look, I'm excited
of Indonesian.
Deepening for stronger growth and sustainable recovery. And we heard from Ibu Satu why that's so important. Australia is very proud to continue its support for the World Bank in Indonesia, including the publication of these Indonesia Economic Prospects reports, which have been in place now for more than a decade. These reports are even more important today to better understand the many challenges ahead and the reforms that are needed as we navigate the post-COVID global economic recovery, which, as we've seen, is becoming even more challenging with high commodity prices, rising inflation, monetary tightening, etc. At this month's Australia-Indonesia annual leaders meeting in Bogor, we had President Widodo and our new Prime Minister Albanese, reaffirm the strength of our bilateral relationship and in particular highlight our shared economic interests. It was the first bilateral overseas visit by the new government, which signals the importance we place in the relationship we have with Indonesia. Also importantly, from that visit, there was a commitment to have investment missions come to Indonesia and go to Australia to explore further investment opportunities and bringing a strong contingent from our superannuation community, which manages vast resources. There was also a very senior business delegation that came at very short notice again to look at opportunities here and recognising the potential that exists in Indonesia and that we do need to do more to unlock the trade and investment potential between our two countries. It's an aspect of the relationship that is somewhat underdone, and I know Ibu Shinta was present at the big business dinner that night, and Cardin does a lot of work with our business community as well, which is much appreciated. The key to realising a lot of these trade investment goals is, of course, a really strong financial sector. And that is why I'm particularly pleased to see this special chapter on financial sector deepening in the report. We know that a strong financial sector is critical for a country's economic resilience and to spur inclusive economic growth for Indonesians. And this was really clear during the pandemic. Financial markets provided continued access to finance during this really tough period. And now, the finance to the economic recovery and beyond. It's also important that the financial system is prepared to face climate-related risks and opportunities and help facilitate a smooth transition to a greener economy by underwriting the investments needed to drive this transition and change. The Australia-funded Prospera program has had a long history of supporting financial sector stability in Indonesia, along with Australia's support for the World Bank and to produce reports like that, which we're here to launch today. And last year's report on harnessing digital technologies and financial inclusion, which is also another really exciting sector in Indonesia that will help drive its recovery out of the pandemic. And look, in closing again, I'd just like to thank the World Bank for producing another highly relevant and timely update on the Indonesian economy. And as always, I hope you all enjoy today's presentation. Terima kasih dan selamat berdiskusi.
Today. Just a reminder to our audience, if you want to join the conversation in social media, please follow our Twitter account @BankDunia and use the hashtag #IEPBankDunia to converse in social media. Ladies and gentlemen, our next session is a keynote speech from the Governor of Bank Indonesia, Bapak Peri Warjio. Pak Peri, the time is yours.
Distinguished speaker, distinguished participants, ladies and gentlemen. Let me start by thanking the World Bank to invite me on this very special event, which is the launching of the World Bank Indonesia Economic Prospect Report for June 2022. I would like to convey my appreciation to the World Bank for constructing this report, focusing on financial deepening for stronger growth and sustainable recovery. I believe this theme is relevant and timely for Indonesian recovery. Let me just stress the following 3 points. First, we do believe that Indonesian economic recovery continue to get going forward, despite the very challenging global situation. Slowing down of global economy, the war in Ukraine, as well as high commodity price and increasing Fed fund rate and other central bank policy rate. We do believe and we are confident our economic growth this year will be growing by 4.5 to 5.3% and increasing to 4.7 to 5.5% owing to strong boost from domestic consumption along with export as well as growing investment. Macroeconomic and financial stability continue to be sound. Current account deficit, even last year surplus, now continue to be surplus and will be very small deficit this year and next year. Financial stability sound with growing intermediation function, lending of the banking to business sector. Inflation, yes, everywhere in the world facing the pressure of the inflation. But we do believe with a strong collaboration, coordination and policy between the government and central bank, we can manage price stability. This year, we forecast our inflation a bit above our upper target of 4%, probably about 4.2%. But this is very low compared to other countries. Next year, we do believe our inflation will come back to our targeted level 3% plus minus 1. So, part 1, we do believe our economic recovery going forward to continue and going to medium-term outlook, which is more stronger economic growth going forward. Number 2, policy coordination. In this aspect, we have to ensure this is the spirit of strong coordination between government and central bank to ensure stability, but also at the same time nurturing economic growth. To face the challenge of high commodity price globally, even stronger collaboration between fiscal and monetary policy. In this juncture, fiscal policy providing more subsidy to low-income household for low premium diesel, electricity, as well as also increasing social program. And also, at the same time, adjusting some prices for middle and upper income. This is the reason increasing subsidy, and we appraise the government to make decision on this, that the transmission of global commodity prices to domestic can be managed properly. So that we do believe our inflation this year 4.2%, but will become back to our targeted level 3% plus minus 1. Second, central bank. We optimize our policy mix. Our monetary policy continue to be for pro-stability. With still low inflation, then we do not need, at the same time, at this juncture, we do not need to rush into increasing interest rate. We will manage our low interest rate policy, 3.5%, until there is fundamental pressure of the inflation. We continue to stabilize our exchange rate, and we start normalize our liquidity. So we increase reserve requirement to 6% this June, 7% July, and September to 9%. Still providing ample liquidity for bank to extend loan as well as participating in government operation. We continue to digitalize our payment system to build our national digital economy and finance, to do the economic and financial inclusion to support SME, including for women and youth. So, while monetary policy for pro-stability, other policy, macro-prudential policy for growth, digital payment system for growth, and we optimize our central bank policy mix in Bank Indonesia, jointly with the government, to ensure stability and supporting economic growth. Let me move to the third aspect, the financial market deepening. Bank Indonesia, this is one of the priority, which is directed our financial market deepening to supporting economic growth and sustainable recovery. There is 3 policy instruments that we do. First, we enlarge and do innovation in the instrument in the market both FX and money market. We continue deepening our domestic non-delivery forward repo market, and as well as building the pricing mechanism through Indonesia, as well as term structure in the money market. Instrument deepening is very important. Second, we also building our infrastructure, money market infrastructure, to be interlinked, integrated interoperability with the payment system. While we building QR standard, Bank Indonesia fast payment, and in the payment system, we building ETP multi-matching, center counter party, and those will be interconnected, integrated, and interoperability. This is also in conjunction in line with CPMI global standard. So soon, Indonesia will be in the global standard for both payment system and financial market infrastructure. The third is, of course, also developing the green financing for sustainable finance. We collaborated with the government and industry how to ensure our financial market deepening, support toward the green economy and green finance. So those are three things that I want to point at this juncture. Congratulations to World Bank for this publication of World Bank Indonesia Economic Report. And don't forget, Indonesia is continue on the economic recovery with high economic growth, stability. Second, very strong coordination, fiscal and central bank, as well as financial sector policy. Third, we continue deepening our financial market to support stronger growth and sustainable recovery. With that, I thank you.
Thank you very much, Bapak Peri Warjio, Governor of Bank Indonesia, for delivering the keynote speech in our launch today. Ladies and gentlemen, next on our agenda is a presentation on Indonesia economic recovery by lead economist, World Bank Indonesia and Timor-Leste, Bapak Habib Rab. Now we'll take you straight to Pak Habib after this video.
The Indonesian economy maintained strong growth in the first half of 2022. But the recovery comes amidst an increasingly challenging global environment, and the country has started feeling the pressures of rising prices and tightening external finance. Several factors have so far played in favor of Indonesia. The reopening of the economy, which released pent-up demand. Flexible fiscal policy in response to COVID and commodity-related shocks. Accommodative monetary policy which enabled increased bank lending to the private sector. And the commodities windfalls which allowed authorities to use subsidies to cushion part of the inflationary pressures. The economy is expected to grow by 5.1% in 2022, with growth drivers rebalancing from exports and fiscal stimulus towards private consumption and investment. Structural reforms in 4 areas will play a bigger role in driving growth going forwards. The first is to create fiscal space through tax reforms to enlarge the spending envelope on pro-growth and pro-poor programs. The second is to prioritize the business-enabling environment, including access to credit, formalization, and digital transition to overturn COVID-19 scarring effects and boost firms' productivity. The third, replacing trade restrictions with a mix of fiscal, trade, business environment, land management, and infrastructure policies to develop greener downstream industries. The fourth, to deepen the financial sector to help channel more savings to productive investments.
Terima kasih Pak Timothy. Selamat pagi dan selamat datang, Excellency Bapak Peri Warjio, Bapak Stephen Scott, Ibu Satu Kahkonen. I'm very pleased to share with you 6 key messages from our latest edition of the Indonesia Economic Prospects, a 6-monthly report led by our senior country economist Y.L. Mansur and our country economist Indira Hapsari. Our first 2 messages are about the economic outlook for the global economy and then for Indonesia. Our next 4 messages are more about the policy implications stemming from that outlook. Our first message is that the global economy is at increased risk of stagflation. Shocks to commodity and financial markets since Russia's invasion of Ukraine in February will sustain severe discomfort to the world economy, which it has already suffered over the past 2.5 years with COVID. There is increasing talk of the world entering a period of stagflation, when both inflation and unemployment are high, but economic growth is slow. Now, unfortunately, the rule book on how to handle stagflation is not one that is used often. In fact, the last time the world experienced stagflation was in the early 1980s. What we do know is that stagflation creates a perfect storm for policymakers. Slow growth requires accommodative economic policies, whilst high inflation requires tighter economic policies. And tighter policies and high debt environments, which many countries are facing, create risk. Projects that global growth will slow from 5.7% in 2021 to 2.9% in 2022, as illustrated in the first chart. And after this dip, there is no rebound projected next year, so growth is expected to remain flat. Whilst growth is slowing, inflation is moving in the opposite direction. The price pressures that were already mounting in 2021 have received a turbo boost with commodity price shocks since February. As illustrated in the second chart, nearly all countries that have inflation targeting regimes now have inflation above their official targets. Markets expect inflation to peak in mid-2022 and then start declining, but to remain elevated over the medium term. Now, most commodity prices are expected to be significantly higher in 2022 than in 2021, and to remain high in the medium term. Oil prices are expected to gradually decline over the medium term, but projected to still remain at $80 per barrel by 2024. Turning to Indonesia, though we do not expect stagflation, our second message is that the global outlook nevertheless poses risks for growth and inflation. Historically, global commodity increases have been positively associated with economic growth in Indonesia. Rising coal and palm oil earnings tend to accelerate private consumption in the country. On the external side, the positive terms of trade shock also benefits the current account, as coal and palm oil exports dominate fuel imports. The fiscal impacts have also historically been neutral, because rising fuel subsidies tend to be offset by natural resource rents for the budget. Now, these assumptions are reflected in our projections. But the context of the current commodity price cycle is also different, given the global conditions that we just discussed. A synchronized and broad-based slowdown in global growth is bound to also impact Indonesia. So unlike most other countries, in our baseline we project GDP growth to accelerate from 3.7% in 2021 to 5.1% in 2022, rising to 5.3% in 2023, as illustrated in the chart. Now, if we look at the table, inflation is also projected to rise, but to 3.6% on average in 2022. Now, this is close to the 4.2% year-on-year inflation indicated by Governor Peri Warjio. Global oil prices have historically fed into consumer price inflation in Indonesia, but the effects are blunted by energy subsidies and on occasion exchange rate appreciation as well. Now, proxy indicators suggest that inflation expectations are on the rise, but most likely still anchored within Bank Indonesia targets. On the external front, if we keep looking at the table, financing conditions are becoming tighter and external market pressures are building up, including through a depreciation of the rupiah most recently. Non-resident sales of rupiah debt has started to accelerate, though equity inflows remain strong. At the same time, we project the current account to post a small surplus in 2022 because of the commodity price and commodity export effects, whilst reserves also remain adequate at over 7 months of imports and short-term debt obligations. So external vulnerabilities overall are therefore moderate for now. But the global economic environment could create important downward pressures on this outlook. A broad-based decline in global growth could lead to reduced demand for commodity exports, triggering production cutbacks and higher prices. This could force fiscal reallocations from pro-growth spending to untargeted subsidies. It could also mean higher borrowing costs and lower investment. And in such a scenario, Indonesia's growth could be lower than anticipated and reach 4.6% in 2022 and 4.7% in 2023, which is consistent with Bank Indonesia's range. I now turn to the policy implications of all this, because the economic outlook raises several trade-offs for policymakers. The first is around using energy subsidies to manage the pass-through of global oil prices to domestic fuel prices. Our third message on this is that whilst energy subsidies may be warranted for short-term relief from commodity price pressures, the case for reforming those subsidies still remains strong. We estimate that explicit energy subsidies are projected to increase only slightly, from 0.8% of GDP to around 0.9% of GDP between 2021 and 2022, which is what we illustrate in the first chart. The implicit subsidy, however, which is that paid to the state-owned enterprises to compensate them for selling electricity and fuel at below market prices, is projected to increase from 0.7% of GDP in 2021 to 1.5% of GDP in 2022, so a near doubling. These subsidies should help to keep a lid on consumer price inflation in the short term, and this can help to sustain the recovery in domestic demand. At the same time, there are two important reasons why the case for energy subsidy reform also remains strong. The first is that subsidies largely benefit middle and upper class households. This is because those households consume large shares of subsidized diesel and subsidized LPG. If these two subsidies are replaced by targeted social transfers for the poor, the vulnerable, and the aspiring middle class, the government could have an additional 0.6% of GDP for spending on development priorities. Now, recent decisions to raise selected fuel prices are welcome, but they will only have a small impact on subsidies, which is illustrated in the second chart. Now, the second reason for advocating subsidy reform is that whilst energy subsidies could contain cost-push inflation in the short term, given that commodity prices are expected to remain sticky, it is worth thinking of a gradual and measured exit plan. And this may require a gradual pass-through of global prices to avoid sharp adjustments from permanent shifts in prices. Now, assuming that subsidies help to contain short-term cost-push price pressures, this should allow some respite for monetary policy to adjust very gradually, as Governor Periwarjio mentioned. This is important because the economy is still recovering, which brings me to the fourth message, that using fiscal policy as a shock absorber gives space for gradual monetary normalization. The challenge, of course, is that inflation forecasts have started to edge up, and quite significantly, which is what we try to illustrate in the first chart. Now, this creates headwinds for monetary policy. The real policy rate has gradually declined to near zero. This is good because output remains below its potential and firms need financing to meet growing demand. But how to respond to the inflation challenge? Bank Indonesia has rightly signaled that it is closely monitoring core inflation to inform policy rate adjustments. It is also using macroprudential tools and payment system reforms to support the real sector. Core inflation has started to very gradually pick up as the negative output gap begins to close. A gradual adjustment to the policy rate would be warranted when inflation becomes more broad-based, which we do expect over the course of the year as demand continues to recover. Another consideration for monetary policy are external developments. As already mentioned, financing needs are projected to remain moderate with a current account surplus, low debt rollover needs, and adequate reserves. All of these provide buffers for a gradual policy rate adjustment. Now, price pressures have also prompted the authorities, not just in Indonesia, but also other large commodity exporters, to restrict exports so as to shield the domestic economy from price pressures. But this brings us to our fifth message, which is that trade restrictions are not a solution to rising commodity prices. Since the start of the war in Ukraine, there were a total of 26 countries that imposed export restrictions on food products, as illustrated in the first chart. Although export restrictions could help insulate domestic markets, they add significant distortions with negative consequences. Export restrictions suppress prices for domestic producers, while at the same time contributing to world price volatility. This leads to speculation and cuts in domestic output, which is the opposite of what the export restrictions were intended to achieve. For example, similar policies in the 2010-11 food price spike are estimated to have accounted for 40% of the increase in world price of wheat and 1/4 of the increase in the world price of maize. This is what we illustrate in the second chart. It is estimated that this tipped 8.3 million people into extreme poverty at that time. So instead of distortive trade policies, targeted measures to protect the most vulnerable are recommended, along with structural food system reforms, which are discussed in more detail in the report. This brings me to the sixth and final message, which is that as macro policy space shrinks, drivers of growth need to shift to structural reforms, as indicated by Ibu Satu Kakonen. Now, these reforms will improve the efficiency of macroeconomic policies, accelerate potential growth, and enable faster economic expansion with less policy support. And it is important to note that Indonesia has been ahead of the pack on this. It has already combined macro policy prudence with structural reforms even during COVID. Structural reforms have included lifting of investment restrictions, tax reforms, subnational fiscal reforms, and others. We would like to highlight 4 additional ones going forward. The first is around strengthening the enabling environment for firm recovery, particularly micro, small, and medium enterprises through access to credit, formalization, support for green and digital transformation, because the report, you will note, shows that MSMEs were disproportionately affected by the pandemic, with many coping through measures that will have contributed to scarring. Secondly, implement trade policies that boost competitiveness, growth, and job creation, which could include the development of downstream industries. There are many opportunities for reform around lifting of non-tariff measures, deep trade agreements, and logistics. Thirdly, deepen the financial system, which we will hear more about from Pa Francesco in the next presentation. With all of the above contributing to combined with tax reforms, will contribute to improved revenue collections for higher quality spending, including through subsidy reform. Let me end here. Terima kasih banyak. Over back to you, Pak Tim.
Thank you very much, Bapak Habib Rab, for your presentation. Now, before we continue, I'd like to remind everyone that you may follow our program in Bahasa or English. All you need to do is just click the language options at the bottom of your screen. Bagi Anda yang ingin mengikuti keseluruhan acara dalam bahasa Indonesia, Anda bisa memilih fitur penerjemah di bagian bawah layar Anda dan memilih terjemahan bahasa Indonesia. Now, we'll continue to the second part of our presentation, which focuses on financial sector deepening. The presentation will be delivered by World Bank Indonesia and Timor-Leste's lead financial sector economist, Bapak Francesco Strobe. Now we'll go straight to Pak Francesco after this video.
A well-functioning financial sector is important to ensure that governments and financial institutions can support the recovery from the COVID-19 crisis and longer-term economic growth. A deeper financial sector is often accompanied by greater financial access, lower costs, and higher financial protection of individuals and firms against adverse shocks. Financial depth is important for Indonesia's economic development. The government of Indonesia is committed to promoting a deep and inclusive financial sector. However, despite substantial progress, Indonesia's financial sector is still too small, too costly, and exposed to global risks to be able to fund the country's development needs and sustainability objectives. Deepening the Indonesian financial sector requires a concerted set of actions that can be organized into a three-pillar reform strategy. The first pillar is to increase the demand and supply of finance by expanding access and usage of financial services, broadening financial market products, and mobilizing long-term savings. The second is to improve the allocation of resources by promoting banking competition, strengthening procedures for dealing with the insolvency, and protecting consumers. The third is to strengthen financial resilience by advancing the effectiveness of financial sector oversight, strengthening crisis preparedness and resolution, and promoting sustainable finance.
Terima kasih Pak Tim, selamat pagi dan selamat datang. Governor Perry Warjio, Bapak Stephen Scott, Ibu Satu Kakonen, I'm honored to be here today on behalf of the Indonesia Financial Sector team to present the special topic of this edition in the IAP on financial deepening. And let me go straight to the key question, which is why financial deepening matters. As we have seen from the introductory video, deeper financial sectors are often associated with greater financial access as more resources are available for allocation to households and firms. Greater financial efficiency as more competition in the sector lower the cost of intermediation, and greater financial resilience by giving access to those instruments that can help individuals and firms to recover from adverse economic shocks. So financial depth is important for Indonesia's economic development. But is the Indonesian financial sector sufficiently deep today? Well, despite substantial progress, and the recent COVID crisis has shown a remarkable solidity of the sector, the Indonesian financial sector is not yet sufficiently able to fund development needs and sustainability objectives, primarily for three structural weaknesses. The first is the size. The sector is too small. And if we look at financial sector assets over GDP, you can see from the chart how Indonesia compares with other countries in the ASEAN region. And if we look at account ownership, Similarly, almost half of the population in Indonesia is still financially excluded. The second weakness is about the cost. Bank intermediation efficiency is still relatively low. And if we look at net interest margins, which is a typical measure of financial efficiency, we see how Indonesia has structurally higher net interest margins compared to peers. And high interest spreads can negatively impact domestic savings and investments and inhibit bank lending. And in fact, if we look at the private credit over GDP, Indonesia is one of the countries with the lowest ratio in the world. Several factors are contributing to this: lack of competition, weaknesses in the institutional environment, and operational inefficiency. And we'll look into that later on. And the third weakness is about exposure to global risk. The small size of the institutional investor base, and you can see from the chart here how Indonesia compares to Malaysia and Singapore, implies a reliance on foreign investors. But this exposes the country to the volatility of capital flows. And it's particularly important in an uncertain external environment like the one just described by my colleague Pak Habib. So, which are the opportunities to deepen the Indonesian financial sector? Well, we think that policymakers have various opportunities in Indonesia to deepen the sector. Given the scarcity of resources vis-à-vis the development needs, and particularly the potential of Indonesia, there are 4 key steps that can be taken. The first is expanding the funding, the sources of fund for the financial sector, so getting more resources into the system. This will provide adequate resources for expanding lending and increasing the usage of financial services. All this is going to support the smooth functioning of the financial sector. It's important, but it's not sufficient, because we still need those resources to be allocated efficiently within the sector. This is going to enhance the smooth functioning of the financial sector. And there is then a key enabling factor, which is a stable sector with a conducive financial sector architecture. Now, by putting together these 4 ingredients, all these can lead to economic recovery and growth. Now, let me zoom into each one of these 4 blocks, starting with the expansion of funding sources. So we have identified 2 main areas. The first is expanding access to digital financial services, intended as those financial services which rely on digital technologies for their delivery and their use by consumers. They have several benefits. They can lower costs, they can increase speed, transparency, security, and availability of tailored financial services, particularly for the poor. And an example is digital credit, which has taken a very big jump in Indonesia by reaching 76 million borrowers over the past couple of years. The second area is about expanding institutional investors. These are an important source of capital in the economy. They can bring opportunities in terms of reducing reliance on foreign investors, as I've just described, complementing bank lending and increased financing diversification, and expanding access to long-term financing through capital markets. Now, how do we expand the lending to underserved segments? So here as well, the first area is about looking at the products and services for individuals. Transaction accounts continue to be essential for individuals and business. They are the gateway to many other financial services. And basic saving accounts like Tabunganku or agent networks like Laku Pandai or Aikade have already been successfully introduced in Indonesia and have increased outreach. But there are also large volume and recurrent payment systems like G2P payments, utility payments, employment payrolls, which are good opportunities to expand access. Similarly for micro, small, and medium enterprises, digital loans can reach previously unbanked firms because they can reduce or eliminate the reliance on fixed assets as collateral and can reach those that were without formal credit history. And finally, the importance of developing green financial markets. These are going to have a central role in facilitating investments in the short run, and even more importantly, in the transition towards sustainable economies in the longer run. But nowadays, sustainable financial markets in Indonesia do not have yet the scale required to meet the funding needs and aspiration of Indonesia. All this is not sufficient. It's not sufficient, and it's necessary to allocate resources in an efficient manner. So starting by, again, digital finance that can help to mitigate the risk through innovative product design. Banks in Indonesia are expanding digital banking services, acquiring fintechs, but there is a risk of segments left behind if they don't have an easy access to cash. So it's important to have agents on the ground that can operate cash-in and cash-out transactions. But to do that, we need a new agent business models which are aggregating different types of transactions at the agent level. Another key building block is about competition. The banking system in Indonesia is dominated by a few players which have a considerable market power. State-owned banks, which are very well run, are very profitable, play an important role in servicing the government business and micro, small, and medium enterprises. And by doing so, they serve the financial inclusion purposes. But at the same time, there are signals of a universal pricing policy which is applied across Indonesia. So the same lending rates are applied across the board, irrespectively of the risk profile of the borrowers. And this is affecting negatively the efficient allocation of resources. Thirdly, you need a strong financial infrastructure, which means having effective credit information systems, with a key role also played by the private credit bureaus, collateral registry to move beyond immovable assets as collateral, an insolvency framework that as of today has a limited uptake by smaller firms because of the high costs, and a strong consumer protection framework, all the more with the increase of digital finance and considering that over 60% of the Indonesians lack awareness of financial services. They mean they don't have the tools to take informed decisions for their future. As I was saying, what is needed is a key enabling factor, which is financial sector stability. So here as well, we identified 4 opportunities to further strengthen stability in Indonesia. The first is looking at integrated supervision. The sector is dominated by financial conglomerates. They have 80% of the banking assets. But most of them have a horizontal structure with a non-regulated holding company which is controlling the group. So it's important to give to OJK the legal authority to supervise holding companies. And related to this is the importance of legal protection of supervisory staff as a key element for supervisory and resolution framework. This is particularly important given now the prominence of risk-based supervision that relies on the judgment of the supervisor more than compliance-based supervision. Having a strong banking crisis management and resolution framework. A lot of good progress has already been done in this respect, but remains some fragmentation. And this segregation of responsibility results in significant challenges when it comes to interagency coordination and collaboration. And lastly is the importance of addressing climate-related risk. Indonesia is highly prone to natural disasters, so it's exposed to physical risk. Based on preliminary estimates, we noticed that 67% of the lending portfolio of banks in Indonesia is exposed to physical risks. And similarly, transition risk can have very high costs, considering that Indonesia has the 4th highest carbon intensity loan portfolio in the world. So, what can be done to address these challenges and seize these opportunities? A 3-pillar reform strategy can help to deepen the Indonesian financial sector. The first pillar is about increasing the demand and the supply of finance. 3 reforms under this pillar. The first is about increasing access and usage of financial services. This can be done by establishing government data platform, so by giving to financial service providers access to multiple data sources through a single platform, and by creating a digital ID. Indonesia is one of the few countries in ASEAN still lagging behind on that. Establishing fully interoperable payment system. A lot of good work has already been done by BI in this area, with BI fast infrastructure, with the QR Indonesia standards, and more can be done also in developing credit infrastructure that can use alternative data. And then promoting open banking services that can create demand of digital financial services, as well as promoting competition. The second reform is about broadening and improving the quality of financial market products. This means continuing to introduce new financial market products. Green bonds, green sukuk have already been very successful in Indonesia, but more can be done in the area of housing finance, infrastructure finance, and municipal finance. And at the same time, given the very small size of the institutional investor base, it's important to attract international investors, for instance, to deal with the infrastructure needs of Indonesia. And for this, it's important to create a market for risk hedging against the interest rates and the currency risk. Finally, mobilizing long-term savings. This means accumulating savings through institutional investors. And to do so, it's important to expand the coverage, increase the contribution, and reducing withdrawals, while at the same time promote the professional management and the appropriate long-term investment horizon for pension funds assets. The second pillar is about improving the allocation of resources through the financial sector. Here as well, we identified 3 reforms. The first is promoting competition in the banking sector. This can be done by strengthening the capacity of lenders to adopt risk-based pricing and shifting away from the universal pricing policies I was just mentioning. Servicing the government business, irrespectively of the ownership type, is another key point. International experience show that when state-owned banks share the risk burden with private banks, they really, especially where there are market failures, they really play the role of a catalyst for financial sector deepening. And then expanding the role of credit guarantees for micro, small, and medium enterprises. The CUR program is a great entry point for MSMEs that don't have access to finance in the first place. But it's important to apply effective graduation policies towards commercial lending, avoiding repeated loans. The second reform is about strengthening the insolvency framework. With the potential increase in bankruptcy following the COVID crisis, so it's important to incentivize informal restructuring. So those out-of-court workouts that do not resort to the court system to address financial distress. While at the same time, the legal framework needs to be updated through the amendments of the bankruptcy law, which was conceived in 1997 at the time of the Asian financial crisis and now requires updates. Thirdly, protecting consumers, which means applying market conduct supervision, but also finalizing the personal data protection law. Indonesia is one of the few countries that doesn't have yet a comprehensive legal framework in this area, and the law has already been in Parliament since 2019. The last pillar is about strengthening the capacity to withstand financial and non-financial shock, so the resilience of the financial sector. 3 reforms here as well. The first is about advancing the effectiveness of financial sector oversights. On one hand, by addressing the gaps and limitations in the regulatory framework for the supervision of financial conglomerates, while at the same time strengthening the legal protection of financial supervisors. The second is strengthening the crisis preparedness and resolution frameworks, so establishing effective bank resolution regime and interagency coordination, which practically means assigning to LPS the clear role as a resolution authority. And then providing clear arrangement for resolution of funding, which means assuming the possibility of using public fund for the resolution of systemic banks, provided that there are robust safeguards. And finally, promoting climate and natural disaster risk management. This means, on one hand, policies addressed to the financial sector for strengthening its resilience to climate-related risk. This means having climate-related stress testing of banks, a climate risk strategy, as well as supervisory guidance addressed to institutions to improve the reporting and the disclosure on climate-related risk. But also working through the financial sector to strengthen the resilience of the real economy. So helping governments, business, and households to shift the risk of climate and disaster-related shocks to appropriate risk carriers, and this can be done by deepening catastrophe insurance markets. So I stop here with my presentation. I thank you very much for your attention. Terima kasih banyak, and I look forward to the panel discussion. Back to you, Tim.
Thank you very much, Bapak Francesco, for delivering your presentation, which completes our presentation today. Now, ladies and gentlemen, we will now head on to the panel discussion, which will discuss our theme today, financial deepening for stronger growth and sustainable recovery. If you want to join the conversation, we invite you to follow our Twitter account @BankDunia and also use the hashtag #IEPBankDunia for the conversation in social media. I will now hand the floor to our moderator, Practice Manager, Finance, Competitiveness and Innovation Global Practice, World Bank East Asia Pacific, Ibu Cecil Theodornian. Ibu Cecil, the time is yours.
Thank you so much, and warm greetings to all. I'd like to first of all greet our keynote speakers. So greetings to Ibu Satu Kakonan, to Stephen Scott, and to Governor Perry Warjo. It's my honor to be the moderator of this panel, which is indeed going to focus on financial sector deepening. And I'd like to give a warm welcome to our panelists, whom I will introduce to start with. And then we will go into rounds of discussions, and I'll have a few questions for our panelists. So first of all, let me greet Pa Abdurrahman. Warm welcome to you. And just as a matter of introduction, let me say a few words about Rahman. He's currently the Director of Assessment and Policy of Financial Sector Stability at the Secretariat of the Financial Sector Stability Committee. Rahman was with AMRO from 2015 to 2019, having served as country desk economist for quite a few countries, including Cambodia, Malaysia, Indonesia, Brunei, Vietnam. And before that, Rahman was head of the subdivision and division at the Ministry of Finance for 10 years, from 2005 to 2015. Rahman has published extensively in books and journals on topics that include fiscal policy, macroeconomic modeling, and financial sector development. And Rahman actually had graduated from his PhD at the Crawford School of Economics and Government from the Australian National University. Warm welcome to you. Let me follow with introducing Pa Reza Yamora Siregar. Greetings to you and welcome. Just a few words about Pa Reza. Currently, he is the special advisor to the coordinating minister for economic affairs for the Republic of Indonesia. Reza is also serving in several capacities that include being senior executive vice president at IFG Progress, the leading think tank, which was established by the Indonesia Financial Group. Pa Reza is also a faculty member at Bank Indonesia Institute, as well as adjunct faculty of the Asian Public Policy Program at Hitotsubashi University. Pa Reza is also the Senior Financial Sector Advisor as the Australia-Indonesia Partnership for Economic Development, Prospera. Reza held notable positions in the past, and those include Chief Representative of the Singapore office at the Institute of International Finance, that was in 2018-2019, Executive Director and Chief at the ASEAN Economist at Goldman Sachs, Singapore, from 2014 to 2016. Before that, he was Senior Economist at the IMF, as well as Lead Economist at the ASEAN +3 Macroeconomic Research Office in Singapore. So warm welcome to you today. Now let me introduce Ibu Shinta Kamdani. Welcome to you this morning. Ibu Shinta is the owner and chief executive officer of the Syntesa Group, where she's responsible for the management and expansion of the group's business interests in Indonesia. The Syntesa Group is an Indonesian group with 16 subsidiaries which operate through property, energy, industrial products, and consumer products. Now, as a business executive, Ibu Shinta is also involved in numerous business and social activities, and I'll just quote a few. She is coordinating Vice Chairman 3 for Maritime Investment and Foreign Affairs at Kadin Indonesia of Indonesian Chamber of Commerce and Industry, as well as the Employers Association of Indonesia. And she's serving in a number of boards that include the Executive Board of the International Chamber of Commerce, the President of Indonesia Business Council, as well as the founder of the Indonesia Business Coalition for Women Empowerment. Ibu Shinta was chosen by the United Nations as one of 30 global corporate leaders to join the Global Investors for Sustainable Development, the GISD Alliance. Recently, she was elected as chair of B20 Indonesia during the Indonesian presidency of the 2022 G20 Summit. Ibu Shinta graduated from Barnard College at Columbia University in New York and from executive education at the Harvard Business School in 2002. A warm welcome to you, Ibu Shinta. And finally, last but not least, let me introduce Pa Ahmad Royadi. Welcome. Pa Ahmad is the Senior Executive Vice President of Treasury and Global Services, a post he's occupied since 2021. He began his career at BRI in 1999, and during his bank career, he served in various positions, which included Head of Investor Relations Division, Vice President of Corporate and Development Strategy, Head of Economies Group, Head of Global Market Group, Head of Liquidity Management Division at the Treasury and Business Division. Pa Ahmad Royadi obtained his MBA Finance from Tulane University in the USA. Thank you very much and welcome. Welcome to all of you. So it's my pleasure today to actually moderate this session, which indeed will focus on financial sector deepening. And what I will propose will be to go around the table. And I have 3 sets of questions for our panelists. So if we all agree, shall we get started? Okay. All right, so let me start us off by a question that I will actually address to, it will be the same question to all of you. I'd like to ask you, after hearing the presentations of our colleagues, Pa Habib and Pa Francesco, what are, from your perspective, the main challenges to make Indonesia's financial sector deeper and more inclusive? And my second question is, which ones do you think should be addressed in priority? So I will turn in the order of my introductions of the speakers to Pa Rahman. Thank you.
Thank you, Bu Cecile. Good morning, my colleague panelists. First of all, thanks to the World Bank team that has set out the discussion on the finance sector deepening in Indonesia in the current Indonesian Economic Prospect Report. This issue, I think, one of critical issues to be need to be addressed in Indonesia. Using various metrics, as I think already mentioned also by Francesco, our financial sector is far behind our neighboring peers. Total asset of the financial sector in terms of GDP still far below Singapore, Malaysia, and Thailand. Private credit to GDP ratio also much smaller than these peers. 44% in Indonesia compared to 134% in Malaysia and 160% in Thailand. Investment loan from bank contributes only around 5% of total investment in Indonesia. I think is very low, while around 70% of the investment sources from their own monies. I think there is an interesting finding on several research that countries with abundant natural resources have challenges to develop their financial sector. For example, for Saudi Arabia, the credit to GDP ratio is still around 60%. Venezuela also only 21%. Brazil, which also relies on natural resources, its credit to GDP is only around 50%. I think it's, but if we look at our neighbor Australia, which share the similar feature, the contribution of bank credit is about 142%, above 100 compared to Indonesia. So the question is, what are the challenges facing Indonesia to develop the financial sectors? First, I think it's also echo what Francesco mentioned earlier. Firstly, the low level of financial literacy in Indonesia. In Indonesia, I think the literacy index is still below 40%. It's quite low compared to our neighboring countries. So the low level of financial literacy leads to low access to the financial services, as well as the financial intermediation function. The low financial literacy also leads to the underdevelopment of the non-bank sector, such as pension fund and insurance that have been less developed compared to other countries. The second challenge is related to the low national saving capacity of the Indonesian people is quite low. This partly due to the lack of the mandatory saving in Indonesia compared to Malaysia. The mandatory saving exists there and also in Singapore. And third challenges that we are facing is relatively low public trust to our financial sector. The occurrence of fraud cases in financial sector, especially in the insurance industry, is cause low public trust to the financial sector. I think those three challenges which must be addressed simultaneously because one and another are highly interrelated. Thank you, Bu Cecilia.
Thank you so much, Pak Rahman. So low level of financial sector literacy, low national savings, and low public trust of financial sector from your perspective. Now let's hear from Pak Reza.
Terima kasih. Thank you very much. Good morning to all of you. Assalamualaikum warahmatullahi wabarakatuh. Again, let me thanks the organizer for having me today. I will just jump into the questions on what are the main challenges, and I think I'm going to repeat some of the answer that Pak Abdul Rahman have basically listed before. The primary challenge that we face at this point, I think, is the lack of public trust. And again, I think Pak Abdul Rahman already mentioned that quite clearly. And I think along that trust, there are two more fundamental issues that we face. One is it's very difficult to gain trust when you don't have much of literacy at the level of public. Right? So again, I'll come back to this issue a bit more, but clearly, especially if I came from the perspective of the non-bank financial institutions, the survey done by our OJK, our Financial Supervisory Authority, for the NBFI, for the insurance, less than 20% of the people surveyed actually understand about insurance. And the number is even lower for the pension fund, which is basically less than 15%. And even for the banking system that we thought has been well developed, again, the number is below 40%. So we thought literacy, I think, is very difficult for us to be able to develop anything and to regain any trust on our financial activities, especially on our non-bank financial activities. Now, in relation to that, I think regulatory and supervisory capacities are also critical in again, beefing up the public trust. Again, the enforcement of well-designed regulations along with the supervision is critical to earn the public trust. Now, in addition to those two, we also face a number of fundamental headwinds. And I think, again, the previous speaker has pointed this. One is affordability of the products, both insurance and pensions. Again, a combination of low income level and high cost of the products. I'm talking about insurance products, for instance, make it very difficult for average Indonesians to think about or even to invest on insurance product or non-bank financial institution products. So affordability is also an issue here. The large informal sector is another challenge that we face. As we know, out of 130 million, roughly, of Indonesian worker labor force, 50 million are in the formal sector. So more are in the informal sectors. So less than 50% are in the formal sector. And out of that 50 million in the formal sector, less than half is actually have access to pension fund. So the capacity of our pension fund is very limited, it's still very shallow. And the structural problem is actually making sure that we have, we need to formalize some of these informal sectors that we have. And that will lead to hopefully that will facilitate the deepening of the financial market. The next issue to me is the digital penetrations. I think studies have shown there's a strong correlations between digital penetrations and financial inclusions. Yeah, the higher the level of digital penetration is the higher financial inclusions. And that also we have seen that also in Indonesia. In 2000, around 2 million of Indonesians have access to internet. By 2019, that number has picked up to about 170 million. And you see also that level has translated into higher degree of financial inclusions. But the key issue about digital penetrations that we need to push for is actually the usage of that digital penetrations. So far, our digital activities are mostly centered around social media, online purchases, and internet banking. So it's still a very basic type of digital activities that we need to develop more. Now, among those list of things, what are the key things that I think we should address as this is your second question as priority? One is definitely literacy. Now, when I'm talking about literacy here, I'm talking about literacy at all levels, Cecilia. I'm talking about the level of public, level of households, students, level of the industry itself, and of course, also we need to help our policymaker and regulators. So all literacy at all levels, and this is something that we hope at the Indonesia Financial Group to support this process through our research, our campus visits, our seminars, our international conference. Just to give you an example, for instance, one of the fundamental shortages that we have is the small number of actuaries that is needed for our insurance sector. Less than 250 registered actuaries in Indonesia for the population of 270 million. Compared to Malaysia, that has about 270 actuaries for a population of only 35 million. Second issue is, to me, that is priority is the strengthening of the regulation and supervisions. We have seen in the previous turbulence of financial market, capacity to regulate and supervise are critical. Our regulator and supervisor has to have the capacity to anticipate the changes, not reacting to the changes. So I think this is something that we need to do as well. And this is part and parcel also in helping for the corporate governance, enforcing corporate governance in our institutions. The last one, I think the third one, and this is something that can be done also immediately, is addressing the high cost structure in some of the financial products that we have. I think affordability is critical, and obviously having a higher income will be good, but in the short run, dealing with cost structure is going to be a way to basically deepen our financial market. Let me stop there, Cecilia. Thank you very much.
Thank you so much, Pak Reza. And we're not talking about the challenges and the priorities that you see. We will talk about your perspective of the reforms. Let me now turn to Ibu Shinta to get the perspective of Kadin.
Thank you, Phil, and thank you, World Bank, for inviting me to give our perspective from the business side, and which pretty much are similar also with the previous speaker that has responded, Pak Abdul Rahman and Pak Rizal. So I would like to just say that I think the World Bank UNIP has provided a good highlight on challenges in Indonesia financial sector to be more inclusive from the comparatively small assets and supply of funds compared to GDP. The domination, I think, and somewhat dependence on banks as providers of financial services, lack of capability to provide a large-scale long-term funding, as well as vulnerability against the foreign funds or capital flights. I think your reports also to acknowledge that there is improvement, and I think we need to recognize this, that's being made by our government, both the Ministry of Finance, Bank of Indonesia, as well as the Financial Service Authority to improve that. And primarily, since we have also the National Strategy for Financial Market Development in 2018, which become a good basis also to the fast development of Indonesia fintech industry in the past 5 years. I think from the business perspective, mapping the challenges to financial deepening and financial inclusion should also take into consideration of the context of the Indonesian people behavior as source of fund, as well as consumer of financial services and the perspective of business. Primarily, I want to underline here the MSME. Financing needs vis-a-vis to their capability to obtain financing at the current regulatory ecosystem. So first, I want to point out that the biggest challenge, I agree with everybody else, which is the lack of financial literacy. I think this leads to definitely many challenges, such as significant portion of unbanked society, underdeveloped saving and investment, know-how, and also habits, heavy reliance on cash for transaction, lack of supply of funds to the financial sectors, also dependence of financial services expansion to existing consumers, limited financial services innovation, and of course many others, including also I want to note here if you know the fund embezzlement or challenges for business, primarily MSME, to obtain credit as well as higher susceptibility to fraud. So until today, we still hear many stories whereby bank officers need to assist MSME to prepare all necessary documents, including their financial report to meet the bare minimum standard to apply for loans. The second is the lack also of regulatory flexibility for financial services providers to serve the unbankable and informal sector. I think this was mentioned also by Pak Lisa. I think admittedly, financial services industry is very delicate and tangled with our national economic stability that they tend to be highly regulated everywhere in the world. And Indonesia financial sector regulation experience as heavy lessons of the 1998 financial crisis, that regulatory-wise, we tend to have a tighter grip in financial services, so much so that the provider, primarily banks, have policy constraint and inherent risk level limitations to extend financial services to the unbankable and informal business sectors, which they consider a very high risk clients. This is also the case when banks are acting as government agents or SPV to distribute government fund for subsidies of soft loans. Loan and credit term today in Indonesia are sophisticated and difficult to comply to, especially by our MSME. Furthermore, I think financial data are scattered and fragmented across institutions that it's not easy to create a financial profile or track record to help unbanked and informal sector to obtain loan. Although this should have been able to be developed by now through cooperation across institutions, government, banks, e-commerce platform, payment system provider, etc. Now, the third would be financial service affordability, and I agree with that as well. And other than difficult terms for credit, another challenge for businesses is to tap into the financial services is the affordability of interest rate or cost of fund. By comparison, I think Indonesia real loan interest rate are higher than real loan interest rate in all ASEAN 5. Indeed, throughout the pandemic, we see significant efforts from Indonesian government to lower the interest rate to be more affordable and stimulate the economy. However, I believe this is not sufficient, as this do not address the cost fund affordability problem sustainably. I think we're talking about inefficient operation costs of banks, BOPO, and also I think Indonesia financial services is not yet designed to be in the support of business scale graduation, as small and mid-sized businesses find it difficult to afford loan at certain scale of loans. So as they are imposed the same interest rate as big corporations. Out of these challenges, I think what we need to do immediately would be to increase access to usage of financial services to address these challenges of affordability, as well as challenges for this MSME, unbanked and informal sector to tap into the financial services. So this is again important to stimulate the real sector and business to grow, as we are facing a lot of discouraging notion to growth from global economy.
Thank you so much, Ibu Shinta, and thank you also for acknowledging the improvements that have occurred in Indonesia and mentioning this National Financial Sector Strategy of 2018 and the fact that it's translated into some tangible changes and improvements on the financial sector. Let me turn now to Pak Ahmad.
Thank you, Cecil. Yeah. Thank you also for World Bank for inviting Bank Rakyat Indonesia in this event. Good morning, everyone. So before talking about challenge, as the bank that focus in the micro and SME, so I would like to share from the opportunities perspective. So from our side, I think this is the opportunity still huge. So with the population of more than 270 million in Indonesia, and then mostly majority in productive age, Indonesia is home of the more than 64 million micro and ultra micro businesses. And then 45 million of them still need additional funding. And then the interesting fact is still almost 20 million that not served by any financial institution, formal and informal. So I think for us, this is become new source of growth and also for other banks. This is also aligned with our vision, BRI. Besides 2025, we want to be most favorable banking group in Southeast Asia. We also want to champion of the financial inclusion. So I think again, this is we see this is for opportunities for BRI in the financial inclusion and financial deepening. Second, I would like to also share the key characteristics of micro and ultra micro customer. Maybe some of the panelists also already mentioned. The first is they have a limited knowledge of financial product. So this is also reflect in the financial literacy index by OJK. That's less than 40%. So the homework is how to increase this financial literacy. The second is the characteristics is cash still being dominant chosen for the transaction method. This is also reflect in the BI data that more than 769 trillion rupiah, this is cash outside the bank. So the homework is how to onboard this cash outside the bank to the system. So it will be financial institution can be used for the more productive purposes rather than only sit in the cash at home. And then the third, I think, similar with other panelists. So the majority of them is they don't have stable income, and they need very short tenor loan, and then fast process. So on the other hand, this is also give a challenge for the bank, because with a very tiny ticket size and also very short tenor. So this is quite expensive for bank to serve this segment. That's why maybe later on I will discuss about how the strategy to address this. And then the fourth one, the characteristics is even though this MSME is familiar with the smartphone, but they still prefer agent bank for doing financial transaction rather than digital bank. That's why in BRI we have strategy to expand to have more and more agent banking. We call it dreaming agent. Currently we have 500,000 agents. So this is a part of our strategy to respond it. So in short, so the most challenging is again accessibility, like discussed before, and then also financial literacy, and also like Francesco mentioned before is data integration, because we need data integration so we can serve them more. So the third one, let me share with you our strategy response to address the challenge. So last year we established ultra micro holding. So it consists BRI that focus in micro, Pegadaian that focus in pound business, and also PNM in group lending. So with this initiative, we can provide more complete and suitable product to serve this untapped market. Yeah. And then also it complete and match the customer journey. Yeah. Because before they eligible for, to have individual loan, they will do in the group lending. And then if they have collateral, they can have a loan from, for example, Pegadaian with the pound business and upgrade to BRI in the micro loan. So I think this initiative also align with our vision and also align with the government goals to increase financial inclusion. And interestingly, also it is also aligned with our investor aspiration, because we are as a public bank, our investor like that we are still focused in micro and ultra micro, and also improve in ESG implementation. So this is part of I think aligned with our strategy. The second one is how we respond. We use strategy hybrid banking business model. So we combine our physical networks, our outlet, and also our agent. We have 500,000 agents. So agent basically they are our customer. We collaborate with them. So basic banking transaction can be done to our billing agent. So I think it is also help accessibility and also reduce the cost to tap this untapped market. Yeah. And also it is also combined with our digital capabilities. Yeah. And then to increase the literacy also, we transform our loan officers. We have more than 50,000 become not only financial advisor, but also as well as a digital advisor. So their responsibility to digital acquisition, like sell digital loan, teach them digital transaction, and also digital education. So this is the third strategy response for BRI. And then the fourth one, last one, I think, again, funding is one of the challenge also. That's why it is also aligned with our ESG initiative. Like currently, we keep improving our ESG implementation, environment, social governance. Like in the asset side, more than 65% of our asset, our loan, this is into category sustainable finance activities. And then from liability side, like in 2019, we issue sustainability bond. So this is the first sustainability bond in issued in Southeast Asia Bank in 2019. That the proceeds already used for green eligible project and also social project. Yeah. So I think this is also to capture the significant increase like ESG investor globally. And then in the near term also we will issue like a green bond. Yeah. So today we just have in the newspaper we announced like a prospectus. This is IDR green bond. Target domestic green investor domestically. So I think that from Mr. Shio.
Thank you so much. Thank you, Pa Ahmad. We've heard about a number of challenges. Just to sum up this sort of introduction to our panel discussion, I'll just summarize them in three. I mean, we've heard that there are a number of challenges that have to do with the borrowers themselves. Financial sector literacy being a chief constraint, as well as the issue of the low national savings and the lack of stable income. And we've also heard about issues that are related to the trust of the financial sector, which are really important to keep in mind. And the fact that a lot of the sort of productive activity or economic activity is still happening in the informal sector. On the financial intermediary side, we've heard our distinguished panelists talk about the fact that affordability of products is still a big issue. And even though we just heard from Pa Ahmad about a number of innovations that have been undertaken by BRI, we have heard also that there's still limited financial services innovation. That said, you started to introduce digital penetration and financial inclusion, and we might hear more about it in the next round of discussions. So that's the second sort of level, the level of financial intermediaries challenges. And then the third is the challenges that are related to the environment. And so Ibu Shinta talked about this sort of lack of regulatory flexibility, which may be constraining to some extent the risk appetite that we may be seeing on the market. So with that was setting the stage. Let's go into a bit more granularity, and I propose that we have a second round. In that second round, I will ask individual questions to our panelists. I will ask you to be brief just to make sure that we get to the third round, which, where I will invite you to talk a bit more about the roles of the different actors to actually achieve financial sector deepening. So for this second round, let's focus on the key reforms that are needed after setting the stage with the challenges. So I will start with the first question to Pak Rahman. And my question is as follows. What key reforms are needed for the Indonesian financial sector to support the, on one hand, recovery from COVID-19, but also long-term growth in Indonesia?
Thank you, Bu Cecil. Having heard about the challenges from other panelists, I think also referring to the report that has been launched today, we agree that the report we agree with the report that a stable and robust financial sector has an important role in supporting the economic recovery and fostering the long-term our economic growth. The government continues to foster further reforms aimed to achieve a deep, innovative, efficient, inclusive, strong, and stable financial sector. Firstly, as we mentioned earlier about the challenges, we need to increase public access to financial services through increasing digital banking, inclusion, and financial literacy functions. In addition, the massive fintech growth in Indonesia also encouraged the government to strengthen its regulation. Second, we need to expand the long-term financing sources. This is closely related to the government's effort to increase the debt of the financial sector as a source of financing for the economy. The government has stepped up to encourage participation in insurance programs, reform in the pension sector, and increase the accumulation of long-term financing. Third, we need to increase also the competitiveness and efficiency of the financial sector, as mentioned by all panelists about these challenges related to the competitiveness. Also, as mentioned in the report, the efficiency of banking intermediation is relatively low, with reflected on the high net interest margin compared to other countries. I think this is very relevant and will be a special note for the government to address. The developing more varied financial sector instrument with measurable risk mitigation, I think this is also very important. For example, investment avenues for the middle and upper class of Indonesian family with affluent wealth, I think still very limited. Therefore, they mostly invest their money in other countries, in this case, I think Singapore. And lastly, improving investor and consumer protection, I think also very important. This is I think very critical to be strengthened continuously through regulation and law enforcement to gain more public trust, because I think this is one critical challenges we face today. I think those are areas that the government need to address to overcome the challenges and to develop further the financial sector in Indonesia. Thank you.
Thank you so much, Pak Rahman. Let me turn now to Pak Ahmad with the following question. What are the main decisions in terms of reforms that you would like the government to take to strengthen the financial intermediation role of the financial sector?
Thank you. Sure. Yeah. So I think in general, the coordination between ministries, central bank, and also regulators is already very improving. Yeah. So like in our experience in establishment of ultra micro system last year, when we acquire like PNM Pegadaian, so the coordination is very good. Yeah, like Ministry of Finance, Ministry of SOEs, coordinating Ministry of Economic Affairs, and also Ministry of Cooperative, including regulator like BI, OJK, LPS, and also from the parliament. So we can establish this ultra micro holding last year very smooth. But in order to keep accelerate the journey, the upgrade from ultra micro to micro and to SME, I think we need like maybe Francesco before already mentioned like integrated supervision for micro, ultra micro regulators. Currently, like because this holding like PNM and Pegadaian, this is not bank, so this is regulated by non-bank financial institution, and BRS, the bank, is regulated by the bank regulator. So I think if it is there's like integrated supervision, the journey to accelerate the upgrade the customer again from ultra micro, micro, and MSME will be smooth. And then the second one, I think from macro prudential policy, I think Perry already mentioned that from our experience, BI already checked. Yeah, before they have this incentive for reserve requirement for banks that have lower LDR. Currently, it is changed to incentive. So from this incentive to incentive. So I think it is this is also a good. Yeah, we have even though like the reserve requirement increase, but BI give incentive for banks that have macro prudential inclusive financial ratio. So if it is above 30%, it will be give incentive. The second one is if bank that have growth higher than the target, it is also the incentive. So I think this is good. But it will be perfect if BI also give incentive that bank that already have optimum LDR, I think. So I think it will be give ability to bank to do financial intermediary, especially with the bank that already have optimum LDR like 85 to 90%. Even though the current LDR is 79%, but this is combination between bank that have lower LDR, but also there are also some bank that already have optimum LDR 89 to 90%. So I think if it is give us more incentive in terms of the reserve requirement, I think it will be support our financial intermediary. I think the third one is related with the implementation in digitalization. Currently, bank with a lot of digital initiative, bank more and more rely on the data. Yeah. So I think again, I agree with Francesco. If there's a single data platform, especially ruled by the government, it will help bank and other players in order to expand this opportunities. Yeah. And then I think the last one is related with the sustainable finance. like discussed before, we already issue global bond, sustainability bond, and also in the near term, we also will issue green bond. So I think if government or regulators have general guidance, especially in the Indonesia, in the financial institution in Indonesia, which guidance or which ESG rules that that Indonesia will follow. So I think it will be better. And then for the domestic one, yes, OJK already have green bond regulation, but going forward, I think if OJK have like sustainability bond, I think it's better. Yeah, so it gives us bank opportunities to tap not only domestic green bond but also domestic sustainability bond, because again the investor currently that focus in ESG is keep increasing. So I think that's Cecil for me.
Thank you so much. Thank you for giving your banking perspective. We are hearing about reforms that are cross-cutting, but we also are hearing about reforms that are specific. We've heard about the fintech regulations and now ESG principles and going from green to sustainable when it comes to capital markets. Let me now turn to Ibu Shinta. Ibu Shinta, from your perspective, what are the main decisions that you would like the government to take to improve access to finance for the Indonesian private sector?
Thank you, Cecil. I bear in mind on the limitation of time that you have, so I'm going to be very brief because a lot of the answers are similar anyway. So I think considering the economic growth challenges that we have in the immediate future, in the short term, what Indonesian business will be eager to see is first expansion, like I said, of the access and pool of fund for business and MSME, like core, including also the simplification of term of credit based on gradation of business scale, meaning the smaller they are, it has to be less complex, less requirements, and lowest burden in terms of interest. Also, second is improve the efficiency and affordability of the loan, primarily by again, improving bank operating cost efficiency ratio. Of course, we talk about through the digitalization of fintech, which will be very helpful if we do this. So I think we would like to see push towards more digitalization or fintech. The third is integration, again, of the financial track records or data. I think this was mentioned also through cooperation across institutions, including through promotion of open banking services and policy that create, again, demand for digital financial services, as also mentioned in the World Bank report. Now, in the medium long term, there should also be efforts, we would like to repeat this again, to improve the financial literacy, because I think development of digital infrastructure also to support expansion of fintech and digital payment services all over Indonesia are crucial. And I think structural reform in financial sector to give better leverage and incentivize on inclusivity, particularly when it comes to financing distribution to MSME and female entrepreneurs. So that's it.
Thank you, Ibu Shinta, very clear. Let's turn now to Pak Reza. And my question to you to finish this round is, what are the key building blocks of an effective strategy to boost the potential of the financial sector for both banks and non-bank financial institutions?
Thank you very much. Again, let me just be quick on this one. Let me touch on two issues. One on the strategy for the macro, at the level of macro, and also at the level of micro. I think at the level of macro, first and foremost, we need to appreciate the fact that the development of the financial sector must not come at the cost of financial instability. So I think that's rule number one that we have to be aware to. And in this case, therefore, we need to have a more balanced development of the financial system. Now, what I meant by that is that both the banking and non-bank have to be developed in order for us to have not only a large financial market, but also a stable one. Just to give an example at this point, if we want to reduce the dependency on foreign financing, for instance, it is critical that the development of pension fund is there, right? And at the same time, also insurance is very important for risk mitigations. So we cannot have the development of the financial system solely based on, let's say, one part, which is the banking side only, with very much less development in the non-bank financial institution, which is what we see at this point. So that's the first one. The second macro aspect that I thought is very important is basically, we have now an opportunity where we are committed to transformations of the economy into the green economy, and also pushing for the penetrations of digital into the economic system, economic activities. Now, these two targets, green economy and digital penetrations, require not only big financing, but also long-term financing, right? Now, I think this is where there's a mutual inclusive here, where the development of the insurance and pension fund will provide the big financing capacity for Indonesia. And at the same time, the development of the pension and insurance also needing long-term investment products, right? Where I think the green and the digital economy will provide a lot more, right? So for instance, we know from 2020 to 2030 financing of green economy, we are looking at anywhere between 25% to 100% of our GDP in terms of financing, right? So I think this is something that the pensions and the insurance can provide, but at the same time, the pension and the insurance need to have a set of more long-term investment products that they can invest on. And this is where I think the green economy and the digital economy will provide. Now, on the micro side, I think the critical part that we need to build our block is on consolidations. Unfortunately, size of asset matters. We see that in the banking system. The larger bank able to weather through the COVID-19 period. And we see the same thing also on the non-bank financial institutions. Those that have the largest size of asset able to go to plow through and survive the crisis, the pandemic, better than the smaller asset non-bank financial institutions. So consolidation is critical. And the second one is basically we need to, again, find the way to improve our corporate governance and our risk management. I think this is best practices for Indonesia. Again, not necessarily best practices of the world, but I think best practices that Indonesia can adopt is something that we need in terms of improving our corporate governance and also risk management. I think that, let me stop there, Cecile. Thank you.
Thank you so much. Thank you to our panelists. I'm going to attempt to summarize this. I do want to make sure that we have the time for a short third round, and I believe the organizers will allow me. But just in terms of what we heard, some very concrete, actually, suggestions of reforms. And I think they go quite well along the three pillars that were presented by Francesco, and I'm going to take them backwards. So on increasing the sort of demand and supply, we've heard from you about the need to boost long-term finance, develop the insurance sector, the pension sector, the importance of growing those institutional investors. And I reserve a question for the third round on that. We've also heard about, in terms of the allocation of resources, the need to go beyond the sort of traditional collateral-based lending into better sort of risk-based pricing. That's something to mention. And then in terms of financial resilience, thank you very much, Pak Reza, for highlighting the importance of the nexus between the macro and the micro. We also heard from Pak Ahmed about the importance of integrated supervision as a way to boost access to finance, but also ensure that the system is resilient. So macro financial stability is essential. It's an essential condition, not only sufficient for financial sector deepening, but that's something that we need to remember. I do note that in the suggestions you made and the reforms, not all of them actually were coming from necessarily the government. There was a mention of investment channels and the importance of having enough asset classes so that those investments don't go outside of Indonesia. That's something that Pat Hoffman mentioned. And maybe it's an opportunity for me then to move to the third round. And the third one is really to look at what are sort of, on one hand, the roles of the different actors for this financial deepening to actually take effect and contribute to inclusive growth in Indonesia, but also coming back to some of the future opportunities that you've already mentioned, whether it's on sustainability, from green to sustainability, or on digital. So my first question is going to be to Pat Hoffman. And again, in the interest of managing our time, you're going to have to give us some teasers. And I do hope that in future, we will have a chance to have a second of such panels. So for Pat Hoffman, what role do you see for the Ministry of Finance and financial sector authorities to support the modernization of the Indonesian financial sector? We've heard about digital penetration, fintech, green finance. We've heard that some reforms have already taken place, but what else? And then what do you expect from the international community? And if you have any suggestions for us in the World Bank, we'd also love to hear them. Thank you.
Thank you, Bu Cecile. I think jumping into the second question, we are very grateful to the World Bank for continuing to work in tandem with the government of Indonesia to jointly increase the contribution of the financial sector in enhancing our economic growth and the welfare of Indonesian people. In general, the key reforms being implemented by the government are in line with the World Bank's recommendation in this report, such as increasing access to financial services, expanding products, as well as the increasing of consumer protection. We continue to look forward to collaborating and synergizing with the international organization as the World Bank is currently doing, especially in terms of innovation and strengthening the financial sector, such as support for financial infrastructure and a green economy, which now become a common concern in the global forum. Furthermore, we view the role of the Ministry of Finance and other authorities in the financial sector, such as Bank Indonesia, OJK, and LPS, as increasingly vital for the development and strengthening of the financial sector. As regulators, the MOF, the Ministry of Finance, BI, OJK, and LPS must continue to collaborate and synergize to create a solid and financial ecosystem to strengthen the financial system stability as well as building our strong governance. I think those are roles of the authorities that can support the development of the financial sector. Thank you.
Thank you very much. And thank you for being crisp and concise. Let me turn to Pak Reza. How do you see the evolution of capital markets vis-a-vis banking? We've heard quite a bit about the importance of nurturing the institutional investors. So what will be the role of institutional investors to fuel this growth? And do you see opportunities for expanding this role on sustainable finance moving forward?
Thank you again. I think the development of banking and capital market are reflections of the development of the economy itself. If you look at the history of the development in Southeast Asia and also in Asia in general, we started the integrations with the regional and global market through international trade. And then trade between partners led to direct investments. Right? The early stages where we have massive trade with Japan, and then we have seen FDI from Japan coming into Indonesia. And we see now the story, the same thing also in the case with China. As we move into the direct investment, the financing of that direct investment usually often came with the home countries or the original country of the investment. For instance, FDI of Chinese are being financed by Chinese banks and FDI of Japan being financed by the Japanese bank. So that's usually the stages of what we call the trade and FDI nexus. Now, at the latter stage, when we start maturing, this is where the capital market becoming very critical. Because again, the investment has become a lot more expensive. There's a bigger size of investment, and also the maturity of investment is longer. And this is again coming back to issue that I mentioned before in terms of our commitment to digitalization of the economy and the green economy. That requires long-term financing and big size of financing. Here, the capital market development is becoming critical. Diversifications of capital market products, especially in terms of long-term maturity, is going to be critical. Now, the institutional investors are important from the level of that trade activities, banking, financing activity, all the way to the capital market activities. And I think this is going to be even more critical when we look at the period where we are on right now, commitment to our Paris Agreement and also commitment to digital penetrations. Institutional investors are very needed in terms of strengthening the capital base of our financial institutions, especially in our case, is basically our insurance. Majority of our insurance, the big one, are actually joint ventures and purely foreign owned. It is similar to the structure of the banking to some extent. And for our pension fund and capital market, the involvement of the presence of institutional investor will also create more stable and deeper financial sector. Again, the instruments that external institutional investor bring in will help pension and also capital market to diversify and expand their financial products. Let me stop there. Thank you.
Thank you very much indeed. Now let me turn to Ibu Shinta. Back to the private sector. How can firms benefit from green finance opportunities going forward? And how can policymakers support them to reap the full benefits of these new opportunities while meeting their climate commitments?
Yeah, so I think from the pool of fund perspective, first, firms can definitely benefit from the enablement and expansion of various green finance instruments in Indonesia. I think the Indonesian government primarily should facilitate the creation and distribution of green blended finance. I think we are talking about blended finance also to enable business to tap many of the green finance opportunity from even non-profit entity. As well, also enabling the exchanges and expansion of voluntary carbon market. Now, why I mentioned this is these are also some of the issues, policy that we are discussing in the Business 20 this year. As you know, Indonesia is chairman of G20, and we have the Business 20, which the Business Engagement Group is now discussing policy recommendation that will be submitted to the government, and we have a finance and infrastructure task force. So I think when we talk about blended finance and also voluntary carbon market, we also discuss primarily on how carbon credit in exchange for availability of the gap funding, environmental based lending or investment. We talk about the project planning assistance, joint crediting mechanism, tax breaks and incentive, also pipelining of invest-ready green projects and climate risk management. So these are some of the issues also that we will be forward on the policy recommendation. But from the distribution point of view, I would like to really encourage, I think, a more public-private partnership for green transition and circular economy. I think PPP potentially provide a useful framework under which public and private sector can definitely pool and coordinate their financial and technological resources more efficiently. And at the same time, climate change creates novel form of risk, which are difficult to quantify and will present unique challenges to public and private sector parties seeking to negotiate a more appropriate allocation of risk between themselves. So I think the PPP should be designed to be more sensible toward the risk assessment, project worthiness, and also collaterals that than those that applies on the non-green business model. The other thing to note also, of course, again, I'm talking about that this channeling on green finance opportunities should also accommodate, of course, the SMEs. This is also important because this is a concept that's still pretty new. There should be more policy support to improve knowledge and awareness to green financing mechanism itself, and providing technical assistance program all the way through a matchmaking platform that link investors with investees. I think given the capability gap to meet green financing terms across business scales and business sectors, the existing of special program for green financing channeling also, I think for MSME, it's greatly needed, and that's something that we should also look into. Thank you.
Thank you very much, Ibu Shinta, and also thank you for highlighting that the SMEs should not be lost in this transition. Let me turn now to Pak Ahmad to hear the perspective of the banks, and then I'll wrap up. I'll attempt to wrap up this really exciting and energizing session. Pak Ahmad, how does the expansion of digital finance change the current role that is played by the large banks to finance the real economy?
Okay, thank you, Cecile. So I think with this current expansion of digital finance, so current role like the large bank, I think it is have to accelerate. Yeah, we have to accelerate our digital initiative. Like for the banks, at least there are 3 areas in digital initiative. First, digitizing the core. So the purpose is how we improve our productivity, like improving loan underwriting. Like currently, all the loan officer currently underwrite the loan using the apps. You don't have to go back and forth to office. And then also, they have to keep accelerate or their digital ecosystem. So how make as many as digital ecosystem as possible. So we have to collaborate more, not only with fintech, e-commerce, etc. So we need to improve our strategy in open banking, like open API, something like that, to keep increasing our digital ecosystem. And then the third one is new digital proposition. So it means that banks have to explore the new digital proposition as the new source of growth. Like previously we discussed before, we keep developing, innovating in like digital loan product, digital saving. So this is part of our strategy to keep improving our digital capabilities in this current situation. And in addition to that, especially for BRI as the unique position, we also have strategy like discussed before, hybrid strategy. So we combine our strong physical networks. We have 1,000 outlets, we have 500,000 agents, with our digital capabilities. So combine all this strengthening. So our ability to penetrate even further to untapped market will be improved. And also we keep expanding our branches banking agent. So we collaborate with more and more our borrower, our customer, so they can serve basic banking transaction on the behalf of BRI. So it will be win-win for customer. They don't have to go far away to perform banking transaction. And then the last one, also as our responsibility to improve digital literacy, we also transform again our loan officer to become not only digital advisor but also not only digital advisor but also financial advisor. So I think it will help customer to smooth their journey to upgrade their business. So I think that's all for me. Thank you.
Thank you so much, and I really appreciate your conciseness. This is a difficult session to summarize, but let me attempt to it for this at least third part. In this third part, we heard from Pak Reza this sort of stage 1, stage 2, which I think is a very good framework for thinking about deepening financial markets. Stage 1 being the model of openness, which is the trade and FDI model, and with it come financial innovations and also new actors. And stage 2 is really where sort of you get to more building these capital markets that then become critical, both for stability, but also for expanding access. So that was from Pak Reza. In terms of the roles that we heard about, I mean, clearly there is a role, it takes a village. There is a role for government. There is a role for the private sector and the civil society. There is a role for the financial intermediaries, banks and NBFIs. And we also heard, upon prompting, the role for MDBs like ourselves. So just very quickly for the government, we heard that government should provide a solid financial sector ecosystem. We heard this from Pak Rahman, and enable the expansion of voluntary carbon markets when it comes to climate finance. And I have to be selective, so I'm just going to pick on a few. On the private sector and the civil society, thank you, Ibu Shinta, for talking about this sort of public-private compact and the need for public-private dialogues and public-private partnerships for climate transition and the circular economy. On the role of the banks and other financial intermediaries, including the newer ones, the importance of sort of enhancing underwriting capabilities as digital finance kicks in, the role of blended finance for climate transition, and also the importance for the banks to reinvent themselves and train their loan officers. We heard about moving from sort of loan officers to financial advisors. And last but not least, from our perspective on the role of the MDBs, in the World Bank, we heard the call for continuing to support the government on financial innovations, as well as areas that continue to grow and learn, such as consumer protection. One thing that was mentioned earlier in the second round was the importance of anticipating, not reacting to changes. So with that, I want to thank all of our panelists for this vibrant discussion today. And I think it's now going to be my turn to go back to our moderator, to our MC for the rest of the program. So I thank you very much for your time, and let's go on with the program. Thank you so much. Back to you.
Thank you very much also for your time, Ibu Cecile Tioronyang, for moderating the very lively discussion today. And also to all the panelists, Bapak Abdurrahman, Bapak Reza Siregar, Ibu Shinta Kamdani, and also Bapak Ahmad Royadi, we thank you so much for your time and your insightful thoughts in our discussion today. Ladies and gentlemen, the panel discussion also marks the end of the IEP launch today. If you're interested to receive the detailed report, it can be downloaded at worldbank.org/IEP. That's worldbank.org/IEP. You can get the latest information regarding the World Bank Indonesia programs via our Twitter account @Bank Dunia. And for our journalist friends, we will hold a press conference right after this. Please stand by on your screen in this room and follow the instructions you have received in your personal invitations. You will have to be eligible to join the press conference, and the instructions are in your invitation. Thank you everyone for your attendance. My name is Timothy Marbun, and on behalf of World Bank team and everyone involved in our event today, we hope to see you again in the next Indonesia Economic Prospects Report. Thank you everyone. Have a great day. Goodbye.